storm warning on Wall Street's horizon. It began not with a dramatic crash, but with subtle shifts that most people overlooked. A tightening here, a rumor there, and a growing sense that something in the nation's financial heartbeat had slipped out of rhythm. The market still moved. Banks still opened their doors. But beneath the calm surface, pressure was building in ways too quiet and too deep to ignore. To understand why this moment still echoes today, we need to return to an America riding the momentum of rapid expansion. Railroads stretched farther. Factories hummed with new energy. Investors poured money into ventures that promised limitless growth. It felt like progress without friction, a future unfolding at full speed. Yet the very forces driving that optimism hid vulnerabilities the public had not yet learned to see. Credit surged through every corner of the economy. Speculation flourished, and powerful institutions, confident in their own stability, took risks that seemed reasonable until they weren't. Quiet imbalances began to form, concealed in balance sheets, overvalued stocks, and loans built on hope rather than certainty. A few analysts warned that the pace was unsustainable, but their voices fell out of place in a world enthralled by expansion. These early signals didn't spark fear, not yet. They felt like distant thunder, the kind that rumbles long before a storm arrives. But thunder has meaning. It warns that atmospheric pressure is changing, that something unseen is gathering strength. And on Wall Street, that pressure was beginning to tighten around institutions that had grown too confident in their ability to manage risk. The first hints of trouble appeared in moments easily dismissed. A project delayed, a major firm hesitating on new investments, a sudden shift in commodity prices. Each event seemed small on its own, but together they revealed a fragile truth. The system was stretched too thin, too fast, and too far from its foundations. These early beats marked the beginning of a transformation, one that would challenge beliefs about stability, expose the limits of unchecked ambition, and reveal just how quickly confidence can turn when the horizon darkens. The unease that had lingered beneath the surface soon began to take shape in sharper, more tangible ways. Banks that once boasted of endless opportunity quietly shifted their tone, tightening lending standards with little explanation. Investors who had spent years chasing rapid gains now paused before signing contracts, sensing that the momentum they relied on no longer felt inevitable. And on trading floors, brokers exchanged glances that revealed what they refused to say aloud. The market's rhythm had changed. The cracks appeared first in sectors that had grown too quickly. Railroad companies, long considered the backbone of national expansion, struggled to secure new financing for unfinished lines. Their costs rose, their projections faltered, and their once confident boards began to question whether growth could continue at its previous pace. These doubts seeped into investor circles, where whispers carried more weight than official reports. A single rumor could freeze capital. A hesitation could stall entire projects. Merchants felt the pressure next. Orders that had flowed steadily for years suddenly slowed. Manufacturers, wary of taking on new debt, reduced production. Warehouses filled with unsold goods as distributors waited for clarity that never arrived. The slowdown was subtle, but its effects traveled quickly, revealing how deeply interconnected the nation's commercial life had become. A tremor in one sector sent vibrations through another, each response amplifying the next. Newspapers tried to decipher the shift. Some blamed foreign markets, tightening their credit. Others pointed to speculation in overvalued stocks or the ballooning debts of major corporations. None of these explanations captured the full picture. The truth was more complicated. The entire financial system was leaning on assumptions that no longer held steady. The optimism that had powered years of expansion now masked a widening gap between perceived wealth and real stability. As uncertainty grew, banks faced their own reckoning. They reviewed balance sheets with unease, discovering loans extended too freely and reserves thinner than expected. Some institutions began calling in debts prematurely, hoping to fortify their positions before conditions worsened. But these actions, meant to protect themselves, intensified the strain on borrowers who depended on predictable credit. The more banks withdrew, the more businesses stumbled, feeding the very instability the banks feared. For everyday citizens, the tension appeared in daily conversations. Shopkeepers spoke of slower evenings. Workers whispered about reduced hours. Families reconsidered purchases they once made with confidence. The change was elusive, difficult to pinpoint, but unmistakable. Something was shifting beneath the country's prosperity, something that hinted at deeper forces gathering strength just beyond the visible horizon. By now, the storm warning had grown impossible to ignore. Wall Street's calm facade was cracking, and the nation stood on the edge of a conflict that would test the limits of its expanding financial world. The question was no longer whether pressure was building, but when and how violently it would break. The pressure that had crept through the system now surfaced in full, exposing vulnerabilities long hidden beneath the glow of prosperity. Markets that once surged with confidence began to stagger under the weight of uncertainty. Each day brought a new sign that the foundations were shifting. A prominent firm delaying payments, a railroad corporation announcing unexpected losses, a bank reducing its hours without explanation. What had previously felt like scattered tremors now formed a clear pattern, one that suggested the financial world was slipping into dangerous territory. Trading floors reflected the shift with a tense new energy. Brokers who once barked orders with absolute conviction now measured their words, listening for cues in the room rather than the numbers alone. The slightest drop in a stock price triggered waves of speculation. A pause in bidding sent murmurs through the crowd, amplifying the unease. Fear had not taken hold. Not yet, but it hovered just above the surface, waiting for a moment when hesitation turned into panic. The conflict deepened as banks struggled to manage the growing strain. Loan officers faced pressure from all sides. Large clients demanded reassurance that their lines of credit would remain open. Smaller borrowers pleaded for extensions to survive tightening conditions. Behind closed doors, executives debated how aggressively to protect their reserves, knowing that any sign of weakness could trigger withdrawal lines at their own doors. The decisions they made in candlelit offices echoed across the economy, shaping outcomes far beyond their walls. Outside the financial centers, the effects rippled through everyday life. Factory owners scaled back production, fearful of being caught with unsold inventory if markets continued to falter. Workers sensed instability in the cautious tone of supervisors who once spoke proudly of expansion. Farmers preparing for the next planting season hesitated to take on new debt, uncertain whether credit would tighten further. The rhythm of the nation slowed, not from lack of demand, but from the quiet dread that permeated every transaction. Newspapers detected the shift and responded with a mix of alarm and reassurance. Some warned that speculation had stretched markets to the breaking point. Others insisted the downturn was temporary, a mere correction in an otherwise booming era. Their conflicting messages added confusion, fueling conversations in barbershops, train stations, and evening parlor rooms. People sensed that the truth lay somewhere in the uneasy space between optimism and fear. Political leaders also felt the rising tension. Advisors briefed them on weakening sectors, fragile credit lines, and the growing risk of cascading failures. Some argued for immediate action to stabilize confidence. Others insisted that intervention would send the wrong signal, implying a crisis where none yet existed. The indecision itself became a force, leaving the nation suspended between recognition and denial. And all the while, the deeper imbalance continued to widen. Corporate debts layered upon speculative investments. Risky loans propped up fragile enterprises. Banks relied on reserves that looked increasingly insufficient. The storm on the horizon was no longer theoretical. It was gathering mass, drawing strength from every delayed decision and every unanswered doubt. The buildup was reaching its peak. Wall Street stood on the edge of a breaking point, and the next shift, however small, would determine whether the system held together or finally cracked under the weight of its own unchecked ambition. The breaking point arrived with a single announcement, brief, unexpected, and devastating. A major financial house, long considered untouchable, revealed losses so severe that it could no longer meet its obligations. The news struck like lightning. Trading floors fell silent. Brokers froze mid-sentence. And across the nation, confidence, the engine that kept market alive, collapsed in an instant. Within hours, the shock rippled outward. Investors rushed to liquidate positions, desperate to escape the unraveling. Stock prices plunged in sharp, violent drops that erased years of perceived wealth. Banks faced waves of withdrawal requests they could not possibly meet. Some closed their doors early. Others limited transactions. Every action, meant to prevent disaster, only deepened the panic. The storm that had gathered quietly for months was now fully unleashed. Communities far from Wall Street felt the impact with equal force. Factories announced layoffs as orders evaporated. Merchants canceled shipments they could no longer finance. Families saw their savings shrink and their prospects dim. Newspapers printed alarming headlines, chronicling the collapse as it spread from city to city. The downturn was no longer an economic event. It had become a national reckoning, revealing how fragile the illusion of endless growth had always been. Policymakers scrambled to respond. Emergency meetings stretched late into night as leaders debated how to contain the collapse. Some pushed for government-backed relief. Others feared that intervention would signal even deeper instability. But the urgency left no room for hesitation. Confidence had evaporated, and restoring it required action that reached beyond speeches or reassurances. Temporary measures slowed the bleeding, but they could not erase the fear that had taken hold. The aftermath forced the nation to confront a difficult truth. The system had grown too fast, too loosely, and too far beyond its safeguards. Speculation had outpaced productivity. Risk had been disguised as opportunity. And beneath the glow of expansion lay vulnerabilities no one had wanted to see. The collapse did not merely expose these weaknesses. It demanded a new understanding of how financial power should be managed in a modern, interconnected economy. Yet from the rubble came the beginning of clarity. Analysts, lawmakers, and citizens alike recognized that unchecked ambition could not sustain a stable future. The era ahead would require balance, restraint paired with innovation, oversight paired with opportunity. And though the damage was immense, it paved the way for reforms that would reshape Wall Street and redefine the standards of American finance. Looking back, the storm that swept across the economy did more than break institutions. It illuminated the cost of ignoring warning signs and the danger of mistaking momentum for strength. And in that revelation, the nation found a starting point for rebuilding its financial foundations with a wisdom hard-earned and long overdue.